Thank you everyone for making some time to come out. I know for many of you it's been a long day. You've sat through a lot of the Jeff presentations. For those that have not met me before, my name's Miles Stoudy. I'm the portfolio manager for the Global Value Fund and also sit on the board with Jeff, Chris and Jonathan. We also have here Emma Davidson, Head of Corporate Affairs for the GVF, and she's also Director of Stoudy Capital. For those of you that don't know, Emma and I are actually married, so you get a package deal when you invest into GVF. It's very much a family affair. The theme that we're going to be talking about this year is risk and managing risk. And I think, if we are perhaps at the tail end of what has been a very long bull market, our focus on risk management, capital preservation is something that perhaps sets us apart a little bit. But as always, we're out here to talk about anything you like. So at the end, we're happy to answer questions on anything that comes to mind. I'm going to start off by saying a few words on who we are and what we do, just a quick reminder for our existing shareholders and for anyone that's new. And we've got some interesting new slides will hopefully help articulate our strategy a bit better this year. Then Emma's going to speak about the company and where we are today, and then we'll get into the main part of the presentation. So just to recap, we are quite a different proposition. So our skill set at the Global Value Fund is finding investments that are trading below asset backing, below $1, and then our skill set is really unlocking that value for our investors. That makes us value investors in the truest sense of that phrase, in my view. But it's a slightly different proposition to what most people mean when they refer to value investing. Most people, when they think about value investing, they sort of refer to value and relative value investing. So I think BHP is cheaper than Rio Tinto, or I think Woolies is cheaper than Coles. And that thinking part, that relative value part, is generally based on earnings models or relative valuation metrics, which is all well and good. But when you look at what the Global Value Fund does, I guess when we say we're value investors, it's sort of absolute value. So it's not relative value. We only invest into situations where we know that we're buying $1 worth of assets for less than $1. So absolute value investors. Our skill set and where we hope to add value for our shareholders is that an ability to unlock this value. And what we're hoping to do for our investors is effectively to provide two sources of return. The returns from these assets that we've bought at a discount, and then hopefully this second source of return, unlocking that value. So two sources of return. How we unlock that value is obviously the special source, the key part of the proposition, and there's really two parts to the arsenal. The first one, which always gets the attention and all the interest, is shareholder activism. So investing into situations where generally there's been a failing in corporate governance, where boards or management teams are not looking after their shareholders the way they should be. Going into these situations, engaging with boards, other shareholders, managers, and in a positive, productive way, trying to unlock value in a sort of a collaborative way. Unfortunately, that's not always possible, and sometimes these situations can become contested. And if that happens, if we're not able to unlock value in a collaborative way, productive way, then we have very thick skin. We've been doing this for a long time, and I guess I'd say we have considerable form in unlocking value in more muscular shareholder activism sort of situations. And we have a very long track record of success, and not just success for our own shareholders, but success for everyone that's been involved in these situations. The second way we unlock value is a trading part of the business. In the securities that we specialize in, there's lots of liquidity events, buybacks, tender offers, that if you're light on your feet, you're not trying to move too much money around, can be really interesting little sources of outperformance, little arbitrages that we find in the market. It's a very important part of my business, and the team and I have been doing this for 10 years and have certainly built up a really good little specialty in unlocking value in that way. And the last thing I should say, just in case people are not aware, I'm Australian by origin, go for all the right rugby teams, but the team and I based in London, as is Emma, and we've been effectively running this strategy from London for the last 10 years. So working together as quite a close team, same team for the last 10 years, pursuing this strategy. So that's sort of who we are. In terms of what we're trying to do at the Global Value Fund, the target that we set ourselves is, over time, to generate equity market-like returns, but with a significantly lower risk profile. And I think, as I was saying before, that focus on risk management, capital preservation, I hope is something that really sets us apart. There's really two ways we go about lowering our risk, and none of them are that sort of revolutionary. The first way that we lower risk is we just invest into low-risk assets. So there's no rocket science in that. Our skill set is unlocking value from discounted asset plays, and what we do is we apply it to a very broad range of different asset classes, many of them much lower risk than, say, the share market. And that underlying pool of assets that we own naturally just has a much lower risk profile. You know, theoretically, it should also have a lower return profile, but the way we're able to target equity market-like returns, so higher returns, is through that second source of return that I was talking about. The second way that we lower risk, just to mention it, it's not a very big part of the business, but we do occasionally use some very modest amounts of hedging in the portfolio. The team and I have spent a long parts of our careers working in hedge funds, and whilst I don't agree with a lot of those techniques, that at the margin some of those techniques can be quite useful, and very occasionally we'll use some modest hedging in the portfolio just to add to the overall risk-reward proposition of what we do. You can see the results of the application of that strategy hopefully here in practice with these two slides. So what we've done here is work out our upside-downside participation since we started the fund. We've been running for nearly 4.5 years now, and over that time we've participated in nearly 70% of the upside of global share markets, but only 44% of the downside. And that great skew between upside participation and downside participation obviously lets us compound really nicely through time. And we believe through a full cycle, with a couple of big sell-offs in equity markets, ups and downs, we should actually outperform equity markets over the very long run just by compounding ahead of the market, going up more than the market, going up much more than we go down as the markets gyrate through time. Anyway, I might hand it over to Emma now. That's a quick summary of who we are, and I might let her give an update on where we are.
Great, thanks Miles. And thank you everyone. It's my absolute pleasure to be with you all today. As Miles said, we thought we would talk about who we are and then how we got here. And this slide always reminds me of why I'm invested in GVF. So far, since IPO at $1, when we listed at $1, GVF has paid out 27 cents in franking and dividends. There are currently 147 million shares outstanding after our capital raising earlier this year in March. And our share price as of the 30th of September was 1.085. Today it's closer to 1.07. And our share price has been a bit soft over the last couple of weeks. And I think that has to be seen in the context of the major share market correction that we've seen over the month of October. Global share markets in Australian dollar terms fell more than 5.5%. And I'm sure you're all aware the ASX fell by 6.1%, one of the most dramatic falls since February 2009. In comparison, GVF's portfolio returns fell by 1.2%, a result that the team and I are very proud of. I think that our share price hasn't quite reflected how well we did over the month of October, but Miles and I are hoping that through the road shows that we'll be conducting over this month, hopefully our message will be heard and we'll be able to get ourselves trading back at NTA and a premium. It's also worth noting that for those shareholders who did come in at the capital raising, they came in at $1.10. They've received 8 cents in dividend and franking, and they have a share price trading at around 107 at the moment, so making them ahead. And I guess the point for me, and the point always, is the whole philosophy of GVF is to pay out all of our portfolio returns to our shareholders in dividends and franking. Just a quick word on the capital raising earlier this year in March, and a reminder of our reasons for raising those proceeds. I know Miles has always guided that we will have an optimum size or ultimate size for GVF at around 200 to 300 million. We're currently at 147. And that is where we aim to get to over the long term. Once we do get there, and we're in no rush to do so, you have me on record as saying that that'll be it for us. That level is the optimum size in terms of, well, we believe it's the optimum size in terms of not stopping us from finding great opportunities globally, but also being big enough to reduce our costs and improve the liquidity of GVF over time. That liquidity element often has a huge impact on a LICS rating over time. It's also worth mentioning that in terms of what has happened to our costs since IPO, I can confirm a useful data point for shareholders is that we've driven down the total expense ratio by 30%. And a lot of that has to do with the fact that we've grown in size and we've been able to negotiate better pricing situations for our shareholders. Driving costs down has been a major priority for me over the last 2 years, and it will continue to be so as we do approach our capacity. Just moving on to the next slide. This slide, as well as the monthly profits reserve that GVF runs on a monthly basis, this slide illustrates where our portfolio returns go. And as you can see, since IPO at $1, shareholders have received that 27 cents that I mentioned, and then also IPO shareholders have received an IPO option, which they could have sold or bought shares with. So since IPO and based on the volume-weighted average option price, shareholders have received 31 cents back on the dollar since 2014. On top of this, our profit reserve currently stands just below 1.5 years, our current dividend payout rate. And this means that our shareholders have that extra added comfort, I suppose, of knowing that even in these volatile markets, there is a 1.5 years worth of our current dividend payout rate squirreled away for the future. Let me hand back to Miles now to run through the macro first and second page stories.
Thanks, Emma.
No problem.
So when I come out, I always like to share my, the views from London, so to speak. I know everyone finds that quite interesting. And I have to confess, most years I come out, I'm generally telling quite a cheery story. Unfortunately, I'm probably going to depress you all a little bit today. But just as a, excuse me, as a disclaimer, these are just my thoughts. Take them with a pinch of salt. But I guess as a general comment, compared to where we were last year, and we were talking about the Goldilocks economy and how things were really entering a bit of a hot patch, we're certainly much more conservative than we were this time last year. And that conservatism certainly being, to a degree, reflected in the portfolio and the sorts of opportunities that we're trying to find for shareholders. But just starting with the big picture, there's a lot to be very grateful for today. So globally, GDP growth is running well above trend. The global economy is growing at nearly 4% a year, which is a blistering pace for global GDP. And that's being powered in large part by what's happening in the US. And the US economy is running red hot under the Trump administration, primarily by these tax cuts that Donald Trump signed into law at the early part of this year. So the US is going very strongly. The other major economy, China, is slowing, but it's slowing in line with expectations and the deliberate aim of the Communist Party to rein in some of this debt-fueled growth that's been running a little bit ahead of what is desirable over the last few years. The other big economic regions, the perennial disappointers, I like to call them, Japan and Europe, even they're doing sort of on a relative basis better than they've done in recent years. So a lot to be grateful for today. The problem is the job of financial markets is to look ahead. So that, stock markets, asset classes, they price in the future. They're not really too interested in what's happening today. And as we look ahead, I guess there's a few things that are starting to worry me a little bit. In summary, I guess if I had to condense down my thoughts, what's worrying me a lot is that I see risks rising across the board, but I don't see returns rising with them. So if that assessment is right, it's not a particularly great place to be investing from. So your risk to capital is going up, but you're not getting any extra return for taking those risks. And my worry about the outlook is really threefold. Firstly, whilst the big picture is looking really good right now, it feels to me that the risks are firmly skewed on the downside. So it looks like growth will definitely slow into next year and potentially slow a bit more than what the market's anticipating. And that's happening at a time when the market positioning is not particularly good at this point in time. And then lastly, and this is a bit of a worrywart, but I'll talk about why it's important. We haven't had a growth scare or a recession for a very long time. And the thing that's concerning us quite a lot at the moment is if there was to be a slowdown in growth, there really isn't much fat in the system in terms of what policymakers might be able to do. But just starting with the big picture, and maybe the cartoon sort of sums up our thinking, a lot of what has been created, the really favourable backdrop we've got today, are temporary factors that are not going to hang around. So the US economy is growing at nearly 4% a year, but that has been powered by a huge unfunded tax cut in the US. So very much a one-time sugar hit, and that is not a recurring part of growth. So the tax cuts in the US have added roughly $100 billion to corporate earnings this year in the US, and that's a huge one-time hit to shareholders. So share markets have gone bananas on the back of that, but that's a one-off effect. So in the US, growth is currently running at 4%. Most economists would put sustainable growth in the US, and over the long run, you can't get away from what your sustainable growth rate is. It just comes down to demographics and productivity. Sustainable growth rates in the US are closer to 2%. So we're at 4% now. By the end of next year, we'll certainly be much closer to that 2% level. So the world's biggest economy is certainly slowing into next year. On top of that, the second biggest economy, China, things are starting to look a little bit hairier in China than they have for a while. Growth is now at a 27-year low. Whilst a 6% growth rate might sound impressive, if your economy and your society is built around a 12% growth rate, that slowdown is quite important. And the challenge that China's really facing today is a political one. How much pain is the Communist Party willing to wear to keep society moving along? How much of a growth slowdown are they willing to tolerate? And the real acid test is, can they keep their hands off this debt pump that's been keeping things going the last few years, ratcheting up more and more debt to keep growth at a level that sort of keeps everyone happy. Adding to all these risks in China, obviously we've had this trade spat, or maybe a trade war between the US and China. The Trump administration seems determined to address these big trade imbalances between China, and then perhaps something else that's been bubbling in the background, also address a lot of these heavy-handed trade practices that China's been using for a long time now that perhaps are not quite so fair. Donald seems determined to stare this down, and what we know to date is he's announced $250 billion of tariffs. They come into effect early next year, so they haven't actually impacted today. And a lot of people, read erroneously when they say, "Oh, well, China's slowing, it's because of the tariffs." In fact, the tariffs, which come into effect next year, have brought a lot of economic activity forward. Exporters want to get ahead of the tariffs coming in. GDP has actually been boosted by this sort of short-term effect of getting ahead of when the tariffs hit. If there isn't a resolution found, then early next year you're going to get a double hit. You're going to get the tariffs coming in, which will depress growth, and that sort of drag forward feature that's been supporting the economy, even though it's been slowing, will turn into reverse. So at a big picture level, growth certainly looks skewed to the downside to me. And as we're looking ahead and we see maybe some growth clouds on the horizon, I think it's interesting to look at market positioning and reflect on where we are perhaps from a sort of a market point of view. This top chart here shows every single bull market in the US, so the longest bull market, the longest and the most reliable equity market we have data for, every single bull market for the last 100 years. And we're currently at a situation where this is the longest bull market on record and the second most profitable bull market on record. And there's not a lot of science in looking at these sort of, these ideas about cycles and trends. But I think for me, one of the reasons you do pay attention to this notion of cycles and bull markets is the longer a bull market runs on for, the more the excesses and the exuberance builds up in the system, and the more we sort of forget some of the hard lessons that crises teach us, importantly. And as I look around today from London, and we have the luxury of investing across lots of different asset classes, seeing lots of different parts of the financial infrastructure, it certainly appears to us that a lot of those hard lessons from the last crisis are being forgotten. In this environment we've had for a long time now of ultra-low interest rates, effectively free money for a long period of time, governments and corporations have been loading up a debt in a way that really hasn't been seen, ever. Debt was, the price of money. Interest rates were cut to zero in the depths of the financial crisis, which is the right thing to do. Governments were desperate. They basically bullied or encouraged companies to get out there to borrow money to invest, hire and build, support the economy, create employment. And that worked very well at the time. But 10 years on, we haven't really weaned ourselves off this environment. And a lot of the debt that's getting taken out today isn't really being put to the most productive use. A lot of it, and we see this in the leveraged loan market and some of the other debt markets, a lot of it's just being used, especially in the private equity space, to fund buybacks, M&A activity, basically using it for financial engineering, not to go into the economy in the sort of the simple sense that we all think of, building a factory, employing people. So the notion that companies are using this cheap debt to support the economy is not really as true as it once was. A lot of this debt that's getting taken out today is really just going to fund the market in buybacks and takeovers, effectively bid the equity markets higher and higher. You can see the bottom chart there, the ratio of global debt to global GDP over the last sort of 15, 20 years. And you can see since the global crisis, debt to GDP has increased by about 40%. Now, to put that in a number that's maybe a bit more, that has a bit more weight or a bit more understanding, that's $30 trillion of additional debt that's been taken out in the last 10 years. That doesn't magically go away, and it's obviously very affordable at a time when interest rates are low, but when interest rates change, that's going to become more and more of a drag on economic growth in general. And for us, the worrying feature is that this is not slowing down. The ratio of debt, the amounts of debt getting taken out continue to increase year after year. So it certainly hasn't been the case that we've reached peak borrowing. So that's sort of the background that we're in. And then It's my job as the portfolio manager to worry about all the things that can go wrong. So I'm not standing here predicting that we're about to hit a global recession, but I think it's interesting just to reflect on the fact that since 1980, there's been about 4 global recessions, one in the early 80s, the early 90s, 2001, and then obviously the GFC. So roughly a global recession every 10 years. It's of course been 10 years now since we had the last global recession, which sounds a bit auspicious, but it doesn't have any predictive power. But it does beg the question of what would happen if there was a recession to come. And we don't know when the next recession will come, but we do know for sure that it will arrive at some point in time. And the good news is, if there was to be a growth slowdown in the next few years, there's no reason at all to think it's going to be anywhere near as painful or dramatic as the financial crisis. The bad news is we are woefully unprepared to deal with even the mildest sorts of growth slowdowns. When economies start to slow, there's really 2 groups of policymakers that we rely on to step up and support the economy. The first one are the central banks. So the central banks, we've outsourced monetary policy to central banks, and they effectively keep interest rates low, lower interest rates when the economy is slowing, and they raise interest rates when the economy is overheating. And what we've done here is show interest rates for the major central banks around the world back to 1980. And we've done some analysis that hopefully it shows in the charts, but effectively from peak to trough, every recession we've had since the 1980s, central banks have on average had to cut interest rates by 5%. Sometimes it's been 4.5%, sometimes it's been 6.5%, and it depends a little bit from region to region and economy to economy. But effectively, to deal with a normal recession, not a financial crisis, but a normal recession, central banks have had to cut interest rates by 500 basis points to stimulate the economy back to sustainable growth. The thing that's obviously very striking about that chart is nowhere in the world has anyone got close to 5% of interest rates to cut if they needed to rely on that sort of stimulus. So what do we do? If there was a slowdown next year or the year after, what ammunition do central bankers have? Well, the only plausible answer is they're going to have to go back to the extreme policy tools that were used during the crisis, quantitative easing and some of the other unorthodox methods that the bankers had to sort of envisage up. They were actually very effective. They get a lot of bad press, but they did the job. But they were, however, highly controversial. And there's a lot of unintended consequences. And I guess for me, the worry that I have is that central bankers used up a lot of that political capital that they have employing these tools in the GFC, and whether they could employ them as effectively as they needed to in a mild slowdown, not a proper crisis, but a more normal recession. I think there's a lot of questions over whether they could deploy those kind of tools as is necessary. So there's question mark number 1. Question mark number 2, the other policy-making group we rely on when economies start to slow are governments. And the government is the borrower of last resort, demand of last resort, Keynesian economics. And in the GFC especially, what we do is we rely on the governments to run fiscal deficits. They come in, they borrow heavily, they support the economy. You have all the natural stabilizers, people become unemployed and draw down unemployment benefits. And that's exactly what you want governments to do. The problem is government balance sheets have expanded enormously, and they certainly don't have anywhere near the sort of latitude they used to have before the crisis came along. You can see here the debt to GDP ratios for a lot of the major economies around the world, and you can see, apart from Germany, who's done a tremendous job of getting its house in order, everyone's balance sheet has almost doubled, or certainly in a much worse state than it was before the crisis. And the sad thing is, it was right to run big deficits in the depths of the crisis. I think a lot of Western governments have gotten used to this idea of living beyond their means, and deficits, even in these good times, even when economic growth's at all-time highs or close to all-time highs, governments still continue to live well beyond their means. And that fact that they haven't put their houses in order means that if there was to be a slowdown, and we were to need to rely on them to stimulate the economy, they're just not going to have the latitude that they used to have. And then finally, and I don't mean to depress anyone too much, but I mean, these are just my thoughts on the world. So I guess my view on life. I mean, for me, looking at the financial crisis, I think the most damaging legacy it's left with us is not what it's done to the economy, but what it's done to our political systems around the world. And Australia, has its revolving door prime minister issues, but is really such a harmonious society compared to what's happening in a lot of other developed countries around the world. The GFC, the hardship it created, the injustices of a lot of the outcomes, the perceived unfairness of it all, has really polarized people in a way that I think we've seen for a very long time. And it's pushed politics to the extreme in both ways. I don't have a political flag to fly here, I'm just observing the situation. And what worries me a lot is that if we're faced with another recession, if we're faced with difficult times, in a lot of countries, I'm not sure if there really is the political will to take those hard decisions you have to take, that you don't have a choice to take. when you have to deal with like taxation and spending, in a recession or a growth slowdown. So this chart here shows the US is obviously not the only situation, but it's a very stark situation, and it's the biggest economy in the world. What this shows is US debt to GDP back to 1790. You can see that it spikes when you have major wars, or in the Great Depression it spikes as you would expect. The government steps in, borrow of last resort, stimulates the economy, and obviously World War II was quite dramatic. Debt and the forecast here, I'll just say, these are not my numbers. So these are the numbers from the Congressional Budget Office, non-partisan body. The government relies on this to do its own budgeting. We haven't taken a view here. This is what the US government itself says is the fiscal trajectory going forward. And you can see debt to GDP really spiked in the depths of the financial crisis, as you would expect it to do. Another great recession, the government has to step up. The thing that is a little terrifying to me is that now, 10 years on, with growth running at 4%, unemployment at a 50-year low in the US, this is what the future trajectory of US fiscal situation looks like. It is really quite hard to comprehend. The US, and again, this is not a political statement, but the US today effectively spends money like it's Sweden, like it's a high-tax country, but it taxes its economy like it is a low-spending mandate like Singapore. It's currently running a $1 trillion a year deficit at a time when the growth is 4% and unemployment's below 4%. And the fact that you can't find consent, and that is not a sustainable situation. That chart is not sustainable. And the fact that you can't find consensus, possibly at the best of times, really puts a big question mark about how our leaders today in a lot of these countries will cope with a situation where you really have hard times and you have to make hard decisions. How do you have a discussion about spending and taxation when this is the best of times and this is what your fiscal deficit looks like? The US is obviously not alone in this situation. Again, Australia is wonderfully isolated. They obviously not immune to having problems, but the scale of the problems are much more extreme in a lot of the other Western countries around the world. Italy, many of you will have seen, just had two populist parties get themselves into office by promising to both cut taxes and increase spending at the same time. So a magic formula, obviously nothing wrong with that. And debt to GDP in Italy is already 120%. So I think for me, the real worry, if there was to be a growth slowdown, and I don't pretend to know when it will come, other than it will come, is that I'm not really sure the politicians today are up to the task of taking on the hard questions that come in those sort of situations. So all a bit gloomy, I guess, with the positioning and the potential for a growth slowdown next year. We are a bit more cautious in what we're doing. We're still finding lots of really exciting things to do, but at the margin, we're trying to find them in asset classes that will be more immune to some of the risks that these themes might bring up.
So I'm not given the job of trying to lift you after that fantastic reality check. And the truth is, the last 4 years that Miles has come out here, shareholders always ask him for a macro view, and he always gives that macro view, and it's always been quite positive, and it's always a little bit difficult to then pitch GVF, which is obviously all about reduced risk and being very kind of diversified and risk averse. But this year we're finding that we're getting a bit more traction simply because things are not looking so hot globally. So as Miles was saying at the beginning, one of the most important things of GVF is that while we set out to deliver equity-like returns through our discount capture strategy, we aim to do so with a much, much lower risk profile than would be found from a basket of international shares. And this slide, slide 16, shows how we achieve that. On the left-hand side pie is how we invest into a wide range of different discounted asset classes. And as you can see, we'll always own some global equity, but it's only ever a part of what we do. And at the moment, you'll see that our see-through cash exposure is actually just 24%.
Equity exposure.
Equity exposure,
yeah.
My bad. Equity exposure is just 24%. The rest of the portfolio is typically made up of investments into corporate debt, listed hedge funds, listed private equity, and even discounted investments into cash. So when you see cash on our pie chart there, that's actually us being invested into a company that owns cash. Many of these asset classes on their own are much lower risk profile than international equities, but then when you pull them together, you benefit from that diversification element, which is so valuable in terms of driving your risk down. It's very rare to see asset classes, all different asset classes move in the same direction at the same time. And so again, you're benefiting from the lack of correlation or the lack of similarity between the asset classes that we invest into. As well as that, the second pie on the right-hand side shows the currency exposures of the fund. You can see that it's a well-diversified basket of developed market currencies with a heavy Australian dollar weighting. And again, our philosophy here is all about risk management. So we don't seek to take a huge opinion, make a huge opinion, or put a big currency view on within the portfolio. We simply seek to express the investable universe through our currency holdings. Obviously, the exception being the Australian dollar. It's obviously not 30% of the investable universe, but the Australian dollar for our Australian dollar investors is the lowest risk currency for us to hold, given that GVF is denominated in Australian dollars. So that combination of investing into assets at a discount, the reduced correlation or similarity between the assets that we invest into, and then the currency diversification on top, all gives us that reduced risk profile. So from my point of view, it's all very well talking about a reduced risk profile, but I want to see the proof in the pudding. So this slide illustrates the results of that approach. And as you can see on the top graph, the first graph there shows every down market that global equities have had in Aussie dollar terms since GVF IPO. That's in the gray. And in the blue is how GVF has performed over the same period. And you can see on the far left-hand side there, October 2018 is the October that I was referring to earlier on, the biggest correction we've seen since February 2009. And again, you know, we're proud to say that we only fell 1.2% in comparison. For me, this is a real-life example of how GVF mitigates risk and how GVF protects the portfolio. We won't always get it right. There's no magic formula. Obviously, there are some months there where we do worse than the market, but they tend to be few and far between. And on average, you know, we are protecting the portfolio on the downside. Miles will go through a few more examples on that in the next couple of slides. But before I hand back over to him, the second graph there on the bottom, that graph is all of the investments that GVF has made since IPO. And if we set out, and if we are going to achieve what we set out to do, i.e. generate reasonable returns on a lowered risk profile, then there should be a skewed risk-return profile to our investments. And hopefully this graph illustrates that. It shows that, you know, when an investment works for us, it has the potential to work really well. And when an investment doesn't really work for us, it hasn't to date been too detrimental in terms of hurting us on the downside. But let me hand back to Miles to run through the different market situations and how we've performed.
So thanks, Emma. So we've spent a lot of today talking about you know, managing risk, and I've spent a bit of time perhaps depressing you all a little bit with how I think that investing risks in general today are rising. If we are perhaps in the late stages of a bull market cycle, these are often the most difficult times to manage an investment portfolio. Risk and return is generally at its highest. There's a lot of volatility in the market, and in truth, the investors that take the most risk, but run the riskiest portfolios, are generally the ones that look the smartest until and if we have a major correction in the markets. Just, you know, a data point that certainly informs a lot of my thinking about life. The long-run annualized return for investing in global share markets from Australian dollars is 5%. That's the very long-run return from investing into global share markets. Over the last 5 years, returns have annualized at 15%. So in my view, you know, it's certainly been very easy to make money in the last few years, and perhaps just a little bit too easy. But putting all that to the side, and given what we've been saying today, the obvious question that comes up all the time for us is, how would GVF perform if there was a major bear market? You know, we don't know if there will be one. I certainly hope there isn't. But if we had a major correction in the market, markets are feeling much more volatile than they have for a while, how would GVF hold up? Now, we obviously can't answer that ahead of the event. I wish I could, but we certainly can't. But we've been going for 4.5 years now, and we've developed quite a good, I think, track record of coping with corrections and a lot of data that we thought we could to look at and show to our shareholders. What we've done here is we've looked at a number of different asset classes. So the chart Emma showed before was the monthly drawdowns, every down month that global share markets have had since we started. What we did here is we looked at what global share markets have done on the whole and basically pulled out the 5 biggest corrections that they've had since IPO. And we haven't cherry-picked anything here. If shareholders want us to look at a certain period of time, please just ask. We're happy to run the numbers. But we picked the 5 most significant ones that we thought were obvious and showed how GVF, how GVF compared from peak to trough. So some of these are quite short and sharp corrections. As Emma was saying, October was one of the worst sell-offs we've had in a very long time. From peak to trough, markets fell about 9% through that October and that October period. GVF fell by about 2% over the same period of time. We've also had some longer corrections. I remember when we launched the fund, there was a lot of hand-wringing in the market, a lot of people also concerned. Back in 2014, I guess, a bit humorously looking back 4 or 5 years later, but in 2014, a lot of the same arguments that you see today were being made. The bull market's gone on for a long period of time. We haven't had a correction. Maybe one is due. And in fact, we had quite a large correction over a 3-month period. Equity markets from Australian dollar terms fell by 14.5% over 3 or 4 months. So not the full 20% that defines an official bear market, but certainly quite a significant prolonged correction. During that period, GVF was down, but we fell by only 4.5% compared to the market falling 14.5%. So against equity markets, I think today we've been able to deliver on what we've said. What we've also done is look at some of the other asset classes. So we do invest into a much broader range of asset classes than just the share market. This chart shows the returns from investment-grade debt in Australian dollar terms over that same time horizon. We do find lots of interesting things to do in the debt space. And just to give some context, and I know it's a little unfamiliar from an Australian perspective, but the debt markets are vastly bigger than the equity markets, a much, much bigger area to play around in. And we often find very interesting opportunities in this space. Investing in debt, for those that are not familiar, can sound a bit exotic, but it is genuinely a much lower risk, lower return proposition in general. That's sort of the standing position. There's obviously exceptions to that rule. And we do invest a lot into the debt markets. Because we hold a lot of debt instruments, I get a question a lot, which is quite a sensible question. How would we cope in an environment of rising interest rates? So when you're investing in debt, there's really 2 main sources of risk. There's the obvious source of risk, that the borrower is going to default on your loan and not give you back your money. But the second source of risk, which is generally the more important source of risk, is changes in interest rates. If you lend someone some money at a certain cost of money, a certain inflation rate or a certain interest rate, and interest rates change, then the value of your historical debt changes. So in simple terms, what that means is as interest rates go up, the price of a bond, the price of fixed debt generally falls. And that interest rate risk or duration risk is most pronounced with investment grade debt. So why we've showed investment grade debt here is when you're investing into investment grade debt, the risk that your borrower is going to default is quite low. It's obviously not zero, but it's a much lower proposition. So investment grade debt is much more sensitive to changes in interest rates. And what you can see here is a period in late 16 into early 2017, 6 or 7 months, where interest rates shot up very dramatically, much faster than the market was anticipating. The yield on the global benchmark, the US 10-year government bond, rose by a full percent, so 100 basis points over a 6-month period. And you can see that anything with some interest rate sensitivity, duration risk, sold off quite heavily. In Australian dollar terms, investment grade debt fell by 9 or 10%. Pleasingly, over that same period of time, GVF was actually up. So we do invest into investment grade debt, but we consciously keep our duration risk quite low, specifically to manage that risk of rising interest rates. And we also, through our diversification, find a lot of floating rate debt, which actually benefits when interest rates rise. The value of floating rate debt becomes more attractive. And then this last chart here shows that other major asset class out there, high yield debt. So high yield debt, as the name implies, is a bit different to interest rate debt. Here, your main risk is the borrower defaulting. And what we've highlighted here, there was a period over about 12 months where there was a lot of stress in the high yield market. A lot of North American shale producers had issued a lot of debt on sub-investment grade terms. Many of them started to get into distress as the oil price fell, and that spread across the entire high yield market. So you had a whole year there falling returns. From peak to trough in Australian dollars, high yield debt fell by about 9%. Now what this doesn't show is this sell-off in high yield debt actually corresponded with one of the equity market sell-offs I illustrated before. But despite, GVF owns high yield debt and equity markets, despite having investments in both sectors, GVF was flat over that same 12-month period. We'd like to stand here and say that we're up in those sorts of markets, but I'm always reminded of Warren Buffett's 2 golden rules. Don't lose money, and then the second one is don't forget rule number 1. So at least we weren't down. And then just coming back to the last sort of formal slide, I guess, just coming back to that idea of 2 sources of return, that the returns from that low risk pool of assets that we own, and then that extra source of return we're trying to add through unlocking the value on the discounts that we've bought. What we've done here is an attribution exercise. So this shows our gross, so before fees, before taxes, sort of a theoretical dollar invested at IPO, how it would have performed and how, where the various sources of returns would have come from over the 4.5 years we've been running the fund. And you can see at the bottom there, the dark navy, that's the returns that have come from that low risk pool of assets that we own, in a diversified portfolio of bonds, cash, equities.
The pie chart.
The pie charts, the first pie chart that Emma was talking about.
Yeah.
The middle one there is the second pie chart that Emma was talking about. Those are the returns that have come from that unhedged currency portfolio that we hold. In the first year of GVF's life, the Australian dollar depreciated quite rapidly, and that was obviously a source of return, though since then it's largely gone into reverse. And then pleasingly, and this is really the whole mantra of what we do at GVF, what we're seeking to do is find investments where what the alpha, the outperformance that we can add is more significant, can be more significant than the actual returns from the underlying assets themselves. And the light blue shows the value that we've unlocked, so the discounts we've unlocked in all of the assets we've bought and bought and sold on behalf of shareholders since we've been running the fund. Pleasingly, at least to date, it's certainly the most important part of our source of returns for us. We've put up 2 case studies here, really just to remind everyone of those 2 sources of return that we find, the trading side of the business, which is exciting but a little bit under the radar, and then how we can apply corporate governance and shareholder activism as a great source of alpha. So this is an example of the trading opportunities that we find, and I think a really good example of how buying things on what might appear to be quite small discounts can still be really exciting opportunities for the fund. Where we're involved in trading opportunities, we really don't like to disclose what we're doing because we don't want to have to share it with other investors, and we might even want to come back and find this opportunity again in the future. So I'll talk in broad terms, but this was a fund listed in London that just owed a very diversified portfolio of UK equities, so think of maybe an AFIC or an Argo. It has this really interesting feature that where once a year you can redeem at NAV from the fund. So if you're a shareholder, you can take your money back once a year at NAV, and quite a powerful feature in terms of keeping the share price and the NAV in line with each other. And what happened was in early January, we were able to buy a very large block of stock from a seller. So one of the big wealth management groups in the UK had made a decision on markets. They didn't want to be long equity markets anymore. We're well known in London as a liquidity provider. We'll make a price on anything as long as it's the right price, a good price for our investors. And we're able to buy this block of stock at a 5% discount, so 95 cents in the dollar. We bought that in January. In April, May, we're able to tender out of the entire position at NAV. So from our position, what we've done is we've been long the equity markets plus almost a guaranteed 5%, a little arbitrage we're able to find. We actually made 6.5% over that 4 or 5 month holding period, picking up another 1.5% of the returns from the underlying fund itself. But the 5% discount that we took out was obviously the most exciting part of what we did. And when we look to invest in the equity markets, this is really the way we like to express what we do. We're looking for that margin of safety, a little buffer in there to make sure that if markets were to wobble, we've still got quite a big margin in there to look after ourselves. And if markets don't wobble or even go up, a great source of outperformance. And then I guess lastly, just to sort of show where a lot of the hard work goes on behind the scenes, this is a great opportunity, I think, of something that we found that was a bit out of favour and overlooked in the market. This is a listed feeder fund into a major hedge fund in the US. So the hedge fund's run by a famous hedge fund manager called David Warren. He's ex-Bevan Howard, and he runs about $3 or $4 billion in a big mutual trust run out of the US. He has a very long track record of doing, in my view, what a hedge fund should do, which is quite a dull, unexciting return profile. I know there's some different sorts of products out that look to sort of generate very high returns, but really what a hedge fund's supposed to do is generate very modest returns. He sort of annualized at maybe 6 to 7% a year, but with very, very little risk. And importantly, very low correlation to what equity markets are doing or other asset classes are doing. He actually specializes in investing in the debt space. And you can see on the bottom left, that the top chart on the bottom left shows his portfolio performance over the last 2 or 3 years. And what hopefully stands out is how dull it is. It's just a very slow drift up to the left. When markets sell off, it doesn't really impact what he does. When markets rally, it doesn't really impact on what he does. This was a feeder fund structure. So what a feeder fund does is it takes, so David Warren runs his big hedge fund. The minimum investment size is $2 or $3 million, well beyond mere mortals like us. What often happens with these sorts of propositions is the manager will launch a feeder fund. So it's a fund like an LIC, I guess, that trades on an exchange and just invests all of its assets up into the master fund. So suddenly, it's a way for mum and dad investors to buy $50,000 or $100,000 worth of stock without needing to meet that $2 or $3 million minimum to invest in the fund itself. Unsurprisingly, in the last 4 or 5 years, as equity markets have sort of gone through the roof, these sorts of products have really fallen out of favor. Investors are much more interested in investing in Apple and Google and Amazon than they are investing in sort of boring, low-risk, medium return products. And this fund had sort of been forgotten about by the market, it shrunk a lot, and it drifted out to a 14, 15% discount to asset backing. We built a very large position at that time, just ahead of a corporate action. And the corporate action was really a catalyst for us to begin a protracted discussion with the board. I can't sort of print a lot of what happened on, but suffice to say it was a robust discussion that lasted several months. And lo and behold, at the end of that discussion, the company decided that it would liquidate, that it would wind itself up and return all of its assets to shareholders. So these are exactly the sorts of propositions we try and find for our shareholders. The proposition for us was we bought into this, this pool of assets at an average discount of about 12 or 13%. The underlying fund, David Warren's fund, made about 3 or 4% over the time that we've owned this fund, so not a terribly exciting return, but certainly not down. But what's exciting for us is on that low underlying risk profile that we've had, we've actually made 14%. So we invested into this big discount. We've redeemed out over the course of this year. We're basically all out now. It was the biggest position in GVF's portfolio last year, full size. We can only go up to 10%, and I think it was 9.5% of the GVF fund. And for us, these are exactly the sorts of propositions that we look for around the world. We're trying to cherry pick these sort of really interesting risk-reward propositions, where the upside is certainly, to us, going into these things, much more apparent than the risk on the downside. And over time, hopefully that's reflected in the numbers and some of the slides that we've talked about today. Thank you.